difference between the ones that get funding and the ones that don't are whether or not you can convey that information in a clear, concise fashion that gets that funder to the next phase. The picture in the center, that's a bridge in Kitchener. Kitchener's where I'm from. I was born and raised there, grew up there, went to Laurier, did the EY thing in public practice, the technical accounting background, and got my CA taken care of and out of the way, and jumped ship not too much longer to a pretty cool startup in Waterloo called Myovision Technologies, and I had the opportunity to be the CFO there, which was an incredible learning experience for me, you know, going over there at 26 years old. And when I joined, the company was doing about $1 million a year in revenue. I had the opportunity to get involved and do a lot of the business planning and the forecasting and the stuff that went along with, you know, growing the business to the next level. So during my time there, we were able to get it up to about $13 million, take the team from 30 people to 100 people, set up a German office to expand internationally, and raise a bunch of VC cash. We did over $15 million when I was there. A couple of years ago, I joined the Mars Investment Accelerator Fund. So for those of you that don't know, the Investment Accelerator Fund is an arm of Mars here, but focused on doing VC-style early-stage investments, and we do them fairly early. We're looking for great teams, timing, and technology with respect to the opportunity. The deal sizes are about $250,000 to $500,000, depending on the stage of the company and fit. And we're looking for the highest potential companies we can find that we can help support their business to get to Series A, and it's a competitive process. So since I've been over at the IAF, I've been involved in driving 7 deals forward. Those deals have syndicated with our investment $7 million on that first investment, and it's been a great experience. So I just wanted to give you a little bit of that vantage point before I kind of get into how I'm looking at some of this stuff. So let's jump into kind of the, I'm going to call it the VC perspective on this. So as I've been going through this over the past few years and with some of my experience from Myovision, there's 2 common things that I know VCs are looking for. There's so much stuff that they're looking for, and it is a subjective process, but there's definitely 2 things that have to happen before you're going to get a deal done. The VC's got to get excited. There's a bunch of stuff that happens in the middle, and then they get aligned and close the deal, and you get your money. So what I find really interesting, it was what that goes on in that arrow in the center, and that's really the due diligence process, the get to know you process. That's when the VC is going to want to understand what's under the hood, the financial models, those types of things. So I'm not going to spend any time talking about the excited part. You guys are excited about your business. You know how to convey excitement. You know how to get people engaged. And it's also a subjective thing. You might not hit it off with the particular funder you're talking to. But what I will spend my time talking about today is some of the things it takes to get a venture capitalist aligned in order to fund a deal. And part of that understanding about alignment is getting that deep understanding of the financial model. And the first thing that's usually an issue is startups have no history of financial information. We had a great idea. We started something up last week. We're really pumped. We're going to drive this thing forward and make a ton of money, cash out, and we'll all be rich. It's great. But that usually doesn't cut it when you need to sit down. You need to be able to convey your information in a reasonable fashion. So what I have noticed is that every startup I've talked to has a bunch of data points, and they're able to leverage those data points to continue to be excited about the business. Those might be things like their beta customers or assumptions about the market, and where they can take the venture kind of based on those. So the majority of startups have these data points. The difference between the ones that get funding and the ones that don't are whether or not you can convey that information in a clear, concise fashion that gets that funder to the next phase. So I'm going to focus on what I think are three critical areas: unit economics, the market opportunity, and the cash flow plan. So I'm going to start out with unit economics. This is your business model distilled down to its absolute basics: revenue and costs associated with your model on a unit basis, some common denominator that makes sense. So that could be an individual customer, a distribution channel, unit sales, or customer's lifetime value. This tells me if the business model actually makes any sense, and if it were to scale, if you would make any money over time. What does this model look like now? What does it look like in 3 years? Those are things that I want to have a discussion with you about and understand your knowledge on. So I'm going to show you an example, and this isn't my example. This isn't a perfect model, but this is an example of something that an entrepreneur that was just a team of two was able to cook up and provide to us that helped get us comfortable. So they said they're going to get to $1 million in ARR. What they provided was information about what happened in Q3 with some of their beta customers, where they thought they were going to land at the end of 2015, and where they were going to be the next year. They were able to talk about the number of customers that they had now, what they thought it was going to be next year and the year after that. They talked about how much they were going to have to discount their services to penetrate and gain those customers. They talked about what type of reporting functionality their product was offering and how that was going to evolve over time from basic reporting to advanced reporting. They provided assumptions around the average revenue per customer and how that would grow. They looked at churn and what customers would stay. And then they made assumptions about the lifetime value of that customer and what it would cost to acquire a customer in each one of those years. They were able to distill down to some key information for us at the bottom based on their assumptions, which was how long it was going to take for them to recover their investment in acquiring that customer. And you could see here, looking from 2015 to 2016, that second bottom line, that they were going to be able to recover their cost of acquisition in 4 months in 2015 and 5 months in 2016 based on the assumptions they have. So of course we wanted to dig into that and understand it. And where that was going to go with their annualized MRR. This isn't a perfect set of metrics. What this is really good thinking and a communication mechanism for this entrepreneur to use. And it was helpful in us in understanding for us in understanding the business. Next, I'm going to talk a little bit about market opportunity. So the definition of market opportunity is the demand that a firm can exploit because it's not being currently addressed. So what we're trying to figure out when we look at a market opportunity is there a glass ceiling that you're going to break your neck on when you're trying to grow this business? Do you have enough room that you can keep driving forward, or are you going to be encumbered because your market simply isn't large enough? A lot of the time, the company will present a Gartner report and show us, hey, our market's huge. It's a $40 billion market. I still find that information interesting because it tells you overall market trends. It says, hey, this is growing, this is contracting, here's why. But I'm not going to base an investment decision on something like that. What we want to see is a more granular, bottom-up approach where you can convey assumptions about your market and give us comfort that your widget at the price that you expect to sell it for provides an attractive market opportunity for us to take a look at with you. So in a bottom-up approach, you're going to look at how many target customers you have in the regions that you're going to target that would actually have a need or interest. What price would they pay? When you aggregate those things, you can figure out what your total addressable market is. When you look at a particular segment, like a region or a demographic, we know what your segmented addressable market with, and it demonstrates that there's some focus. I'm going to take another example from a company that we were working with that conveyed this well. Again, not saying it's perfect, but they were able to get their point across. So in this case, there was a company that was providing hardware devices and a SaaS-based component to their business. They were going after a professional athlete market and amateur athlete market. They were able to get some credible data showing the number of registered athletes in that particular vertical by each region. So we had an idea of the target number of customers in specific regions. Then they were able to take their price point, figure out what that meant in terms of total hardware sales if they were to sell to the whole market. That's the second column. Then if you look at your market size on a recurring revenue basis, using those same number of registered users, they were able to figure out what the annual recurring revenue opportunity is and slice the pie up to identify where the best opportunities were. So at the end of the day, the conclusion was there was about $1 billion in hardware that they could sell in these regions, and they had an opportunity to capture $650 million in recurring annual revenue. Are they going to get all of that? Absolutely not. But it set the tone to show us how big that market opportunity was. The next question that we have to ask is anybody else competing in that market? Who else is going after that pie? Because that can limit it as well. What's unique about your product? How much market share do the competitors have? Are they well funded? Answering these questions gives us comfort about your knowledge of the market, gives us comfort about your ability to grow in an unencumbered fashion. I'm not going to talk about the competitive landscape and how to present that in any more detail, but just know you're going to need to do that, and you're going to need to convey that in a clear and concise fashion because it directly impacts our view on the market opportunity. So the last piece that I'm going to talk about is the cash flow plan. So this shows how you're going to execute on your market opportunity over a relevant period of time. It's really simple. Amount of money coming in, amount of money going out over some period of time. When I ask for a cash flow plan, I know that it's really challenging for a company to come up with, especially if it's a two-founder team that doesn't have any financial background. Maybe they don't have people involved in the company that can help. But why I'm asking for it is not to get the crystal ball or some perfect prediction of the future. I want to know that the founders have some understanding of what it's going to take to grow the business and can make reasonable assumptions that they can defend in order to show me that they know where this thing needs to go. So I'll show another example here of a hyper-simplified financial statement of a forecast output. So this was a company that was selling a hardware widget. They did a quick ship order, low cost of inventory, and they projected out over a 5-year period. They broke it down as simply as they could. Cash in, here's the revenue or sales I'm going to get. And in this case, sales and revenue were so tightly linked that there's no timing lag to really worry about. What is the corresponding cost of that? They showed the margin as well, which was handy. It's not a correct financial statement format, but it got the point across. They're going to make a bunch of money on these hardware widgets. Here's how it's going to grow. Then they were able to walk through the key cash out assumptions, salaries, the fact that they needed to invest in working capital to keep growing the business and keep investing in inventory, rent, office expenses, R&D, prototyping, legal, accounting, marketing, and then get down to the point where they could show us what their operations were generating in terms of cash flow. Negative in the first few years, turns the corner in the third year, and grows well for years 4 and 5. In order to fund the deficit, they knew they needed some equity and were able to identify some sources of capital that they could look for in those first few years. All of this is rolling together, taking an opening cash balance and ending up with a closing cash balance at each year. This is not the type of statement that they're going to manage their business to, but it shows us that they know how their business is going to grow. They have supportable assumptions behind this, which was all included in various tabs. Not the prettiest thing, not the most perfect financial model, but they could talk about it intelligently and defend their assumptions, and that gave us more confidence in their business plan. So I'll just leave you with some final thoughts. You know you don't have historic financials when you're just starting up a business. You know that, we know that. And you don't have the ability to predict the future. You do have data points, and you do have the ability to figure out some mechanism to clearly communicate how that data is relevant in terms of growing your business. And it's that mechanism of communication that's so important in working with external parties to get them excited about your business opportunity. I'll leave you with this. It's an analogy. If you were going to build your sweet dream home, and you were going to go to ask the bank for money to build your dream home, would it be unreasonable for them to ask for some blueprints first, or to ask if you had those? Not at all. And it's no different when you're working with an investor. So be prepared to go under the hood, spend time talking about it, and show them that you have a solid plan to pour the foundation.